The 2008 financial crisis was caused by a combination of factors, including lax regulation and oversight, risky lending practices, and a bubble in the housing market. One of the key causes of the crisis was the widespread use of subprime mortgages. These are home loans made to borrowers with poor credit, and they often came with adjustable interest rates that could reset to much higher levels after a few years. Many of these loans were bundled together and sold as securities to investors, and they were given high credit ratings by rating agencies, even though they were very risky. Another factor that contributed to the crisis was the use of financial derivatives, such as mortgage-backed securities and credit default swaps. These derivatives were used to spread risk and make the financial system more stable, but they also made it more difficult to see where risk was concentrated and where problems might arise. As the housing market began to cool and interest rates rose, many borrowers with subprime mortgages were unable to make their payments. This led to a spike in foreclosures, and the value of the securities that were backed by these mortgages began to decline. This in turn led to losses for the banks and other financial institutions that had invested in these securities. As the crisis spread, many large banks and other financial institutions began to fail, and there was panic in the markets. The U.S. government intervened with a $700 billion bailout package, known as the Troubled Asset Relief Program, TARP, to stabilize the financial system and restore market confidence. However, the crisis severely impacted the global economy, leading to a severe recession and resulting in millions of people losing their jobs, homes, and savings. It also exposed the lack of proper oversight and regulatory framework in the financial sector, which was later addressed by the introduction of laws like the Dodd-Frank Act of 2010.